Hi everybody, the 4 Mapletree REITs have announced their half-yearly result on the last week of October. So today I'm going to talk about my view on their result and also on their future growth. Now let's talk about the first one is Mapletree Commercial Trust. This is a newspaper headline talk about Mapletree Commercial Trust. First half DPU have raised 5.3% as property income climbed by 10.7%. So this is a headline news from Business Time. Let's dive into their result. So from this table you can see that everything looks very positive. Everything is up, and we'll drawn to zoom into their DPU have actually raised to 4.39 cents, is about 5.3% compared to first half FY 2021. But do take note that this is based on last year where it is during the COVID period. Thus, you are comparing something it is on the low side, especially on the VivoCity aspect. Let's zoom in further. Their NAV actually have maintained the same of 1.72 compared to 1st of March, so the NAV didn't really move up, it maintained as the same value, and their gearing have actually maintained at 33.7%. It is same as last year September, which is 33.8%. So there is not much change in their gearing also, as actually they didn't do any acquisitions since last year until today. And let's look at their segmental result. So we can see that Mapletree Business Center, actually the full value already come in. We can see that actually there is no change in their revenue, in their property expenses, in their net property income. So the only change is VivoCity, which is now is a much better state compared to last year. And thus we can see that the revenue, the property expenses, and the net property income for VivoCity have increased, and this indirectly caused the REITs net property income to increase. Another part is the pre-termination of the M Tower. However, do take note the M Tower contribution to the REITs is on a low percentage compared to the Mapletree Business City and VivoCity. Let's look at the occupancy rate. We can see that the M Tower occupancy rate actually have increased from 69.7 last year to 72.3. But based on September 2021, actually the committed is 80.4%. Despite the low occupancy rate, but actually based on the risk manager, the M Tower is still in the money. Why? Because of the pre-termination by one of the big tenants. The big tenant have to compensate the REITs income, and currently the REITs are still collecting sort of rental income despite low vacancy rate. So this is nothing really to alarm on. And also because M Tower, the contribution to the REITs is more on a smaller percentage compared to VivoCity and Mapletree Business City. One thing good about this REITs is that I have a positive rental reversion of 2.3% of the portfolio. Okay, there's a change in the rents, and despite this current market condition, the rental reversion is positive. However, let's look at the shopper traffic focus on VivoCity, where we see that they don't really have a much improvement on the shopper traffic for the first half. Q1 and Q2 is still 6.0 and 6.6, but compared to last year, the second quarter of last year is about the same. So mainly it's because only the last year first quarter is on the low end, as that we are in the height of the pandemic period. And from this chart we can see that the rental sales and the shopper traffic, when compared to 2019, we are still not out of the wood yet. We can see that they have not go back to the 100% mark, so that means we are still underwater. But this is also a positive side. When we start to open up more, the shopper traffic and the tenancy will able to move up. However, do take note that VivoCity is a hybrid shopping mall. What does that mean? That it is not a suburban mall, but it also not a downtown mall. It will depend on two parts. Depend on local to go to that mall. It also depend on tourists. And we know that the tourists, even we have a VTL lane, it's more like people want to travel out of Singapore to go for holidays rather than foreigners want to come to Singapore for holidays. So this will take some while for VivoCity and also some of the downtown mall to really actually to go back to the pre-pandemic level. Let's look at the chart So we can see that Mapletree Commercial Trust for this year, they are more towards the sideways movement. There's not much growth on that, but they also didn't really drop, mainly because the start-stop of the tightening and loosening of the alert, and this indirectly impact the REITs from growing up, but also because of the strong fundamental REITs, it actually didn't really plunge out. So it's hover around $2 to $2.20 that range now, and currently I don't see there's any catalyst for the share price to move really up, or also negative news for the share price to move really down on that. And when we talk about REITs, we will talk about growth potential. Do we able to grow by doing acquisitions? And we know that Mapletree Industrial Trust for the past 1 year, they have not really do acquisition. The last one is acquiring the Mapletree Business City. But we know that there is a sponsored pipeline of properties for Mapletree Commercial Trust. However, this pipeline has been there for quite a while already, and it doesn't really mature enough to fit into this Mapletree Commercial Trust. And thus, the risk manager may also need to look for third party if they really want to acquire properties. One thing I like about this risk manager is the risk manager will want to look at property first. It must really fit into their strategies. So do take note, this is a Singapore focused commercial REITs. Their office buildings are mainly on the city fringe, plus of course shopping malls like Vivo City. So they will want to look for similar type of properties. And the sponsored property currently, we call that they are not really mature enough. What does it mean? They can't really add values to the REITs if they were to acquire at this juncture. And I think there is no visibility of third party property available for them to do acquisitions. As the risk manager have clearly sound that they will mainly focus on property that fit three financial metrics besides fitting the asset. One is DPU positive, NPI positive, NAV positive. So these are the three financial metrics they are looking at. And actually, I feel very comfortable with holding this risk is because the risk manager only looking at property that have these three values. And when they really find this property that these three values and they acquire it, definitely will be benefit to the investor rather than just go outside just to buy property for the sake of buying properties. And with a headroom of 1.8 billion for these REITs, if they really have a good property for them to acquire, I don't think there is a need for them to do any equity fundraising. Okay, unless they buy property that's more than 1 over billions in asset, which I doubt that there is anything that is in the near term. Okay, now let's move on to the second REIT, which is called the Mapletree Industrial Trust. From the newspaper headline from Business Time, we can see that it said that Mapletree Industrial Trust Q2 DPU have up by 11.9%. So this REIT's AUM have grown to 8.5 billion based on from their previous report is only 6 over billion, and their property have become 143. And we can see that the data center contribute more than 50% of that, and that's their first target. Their ultimate target is the data center to able to contribute about 2/3 to the REIT's holding. So that means there is more room to grow for the REITs to continue to acquire data center globally. And one thing about this REIT is we can see that the dividend actually on year is increasing. And in fact, this REIT is the best performing REIT over a 10-year period. If you hold this REIT for 10 years, actually you get the best total annualized return compared to the rest of the REITs listed in Singapore that have more than 10-year history. From here, we can see that the DPU actually have increased by 14.2%, but do take note this is also based on last year result, where actually may not be a real indication of the REITs that actually have performed so well, okay, based on the percentage increase. Let's look at their NAV. Their NAV actually have improved from $1.75 to $1.78, and this is what I was looking at. I always look at NAV increase on the REITs on a year-by-year basis, on a quarterly-by-quarter basis, or even a semi-annual basis, which indirectly will be positive to the share price of the REITs in general. The gearing, however, have increased from 31% on last quarter and 30th of June to 39.6%. The main reason is because of the acquisition of 29 data centers in US. This has indirectly bring down their debt headroom to about 700 to 800 million. However, their interest rate cover ratio is still pretty healthy for these REITs. But do take note that their fixed rate of debt actually have dropped from 95.8% to 57.7% because of the property they acquired from US, which is based on floating rate loans. But they will slowly draw down this floating rate loan and slowly will convert to the fixed rate loan. So we should able to see from the next quarter, the fixed rate percentage of total debt should increase over time. And one key concern about this REIT is the occupancy. Okay, we can see that the business park occupancy actually have dropped from quarter on quarter, and also you can see that the data center actually occupancy have dropped from 98.3% to 94.5%. The key reason for the data center drop occupancy is because of the newly acquired 29 data center in US, where at the point of acquisition it is only 87.8%. And there's one property they acquired out of this 29 property, the occupancy is only 63.5%. So this indirectly have bring down the occupancy rate of their data center. But you may also look at the other way, that they are aggressively and actively trying to get tenants for the new property they have acquired. So we'll expect the occupancy rate for the data center to improve in the next quarter. The next concern is on the business park, which are business park 100% in Singapore, and we know that the pandemic have actually affected a lot of us, and work from home become a norm currently, and this have caused the occupancy rate of the business park to come down, and we only will expect that it will bottom up maybe towards middle of next year. We also see there is a negative rental reversion on their business park. We can see that the business park rental reversion have been dropping, and even for new leases is even asking for lower rent. So this will be the challenge we will see on the business park aspect for these REITs, and we may only able to see like maybe towards the second half of next year for the business park segment to be improved further. So this is the 2-year chart for Mapletree Industrial Trust. We can see that the REITs recent performance this year was not really fantastic, and in fact that you can say that it is almost flat or slightly down for this year after they have a good run in last year. So near term side, I don't foresee any catalyst for the REITs to move up, as there's still some several headwind on that. And also the next concern that we want to look at, is there any growth potential for the REITs? So they have this redevelopment where they're going to redevelop into a high-tech and a built-to-fit facility for the anchor tenant, and we can see that the plot ratio have increased from 1.5 times to 2.5 times. However, this property will only see it contribute to the REITs towards later part of second half 2022. Next is on the data center acquisition side. Currently, there is no pipelines or no visibility on whether there will be any data center they will be acquired. We will not rule out there will be acquisition from data center out of the US side, maybe on the Europe side. However, based on their past record of purchasing data center in bulk in a package deal, that means they don't buy data center one at a time. So with a debt headroom of 700 to 800 millions, I would expect that if they were to do a acquisition on data center going forward, they may need a certain form of equity fundraising. Okay, be it by private placement or preferential offer, that one we will only know when it is officially announced, when they have a property to acquire. Let's look at the third Mapletree REIT that have announced a result. It's called Mapletree Logistics Trust. Mapletree Logistics Trust posts 5.7% growth in their second quarter FY 2122 DPU of 2.173 cents. So it also posts positive result. Actually, in fact, most of the REITs all post positive result. To take note, we are all coming out from the low base up. So thus most of the results have to be positive. And this is their asset, and you can see that their asset actually has scattered over around the Asia Pacific Oceans, but also include on the Indian Ocean side, where they have a small weightage on the Indian properties, where they actually start to expand to that in the recent year. And look at the DPU, we can see that the DPU actually have increased by 10.3% on a year-on-year basis, from 3.852 to 4.25. Actually, this is a very good increase for these REITs on the logistic aspect. But of course, they are on the new economy sector for the REITs. We also expect them to grow on a higher rate basis. The aggregate ratio is still maintained at 38.2%, and the net asset value is still maintained at 1.32. And from there, we can see that the interest cover ratio is 5.2, and the adjusted is 4.3, is still very healthy within the MAS requirement. The occupancy rate is still pretty healthy for this REIT, for all the market. As I mentioned, they are in a new economy, they are in a warehouse, in the e-commerce, which is actually in an in-demand industry currently, and high occupancy rate is expected for these REITs. And based on the price chart, we can see that they are still hover around their all-time high of $2.21 to around $2 that price range in the current near term, as currently there is not much catalyst for the share price to really move up. But the downward pressure, I think, is being supported, which I don't think there is any downside risk for the risk in the near term. Let's look at acquisition aspect and growth aspect. These REITs have made an acquisition of 1.6 billion last year. And this year, they have mentioned that they were able to make the similar value of acquisition as last year. That means it's also about 1.6 billion. But we can see that for the first half of this year, there's not much acquisition activity. So we'll expect the acquisition activity to ramp up in the second half, especially they will have pipelines of properties from the sponsor on China and Vietnam market, and they also will have a potential sizable of asset from a third party from the Japan market. With a debt headroom of 1.5 billion, I doubt there will be a massive equity fundraising if they were to go all out to acquire all these properties. But however, after acquiring this group of property, because the gearing will go up, so they will definitely need certain form of equity fundraising to bring down the gearing back to below 40%. The last Mapletree REITs that announced the result is Mapletree North Asia Commercial Trust. The REITs that have listed in Singapore for more than 10 years, the top three that give the best performance return is Mapletree Industrial Trust, Mapletree Logistics Trust, and Mapletree Commercial Trust. However, for Mapletree North Asia Commercial Trust, it has a less than a 10-year history, and although based on 5-year performance, it is not the best. It is not ranked in the top tier. One of the reasons because of, I think everyone will know of the Hong Kong protests, which actually affected the risk quite a lot, but initially they got some volatility when they start with the China market also. This is a news headline. You can see that Mapletree North Asia Commercial Trust, their DPU up 19.1%. So that is very high, but however, we need to reference back it is compared to last year low, where their retail business on China and Hong Kong have been really affected by the COVID. So sometimes when you look at the headline news, please don't just jump in that it is really a good performance. We need to dive into more detail on that. So let's look at the first half financial result. Everything have went up and the DPU have increased to 3.426, which is increase of 90.1%, but that is from the low of last year. We can still see that Festival Walk is still the major contributor to the REITs. Despite they start to expand their mandate and start to buying property in Japan, buying property in Korea, however, Festival Walk is still a gigantic property to these REITs. It still contribute about half of the REITs. So if the REITs were going to bring down the contribution for Festival Walk, that means we will expect more acquisition will need to come. Their current gearing is 41.4%, although it's still within the threshold of 45%. There is some headroom of that, but however, with the asset under management of 8.4 billion, their headroom is only 554 million. If they were going to continue to acquire office property or even shopping mall property, which actually the quantum will be in a few hundred millions, and I will believe that they will definitely need to do equity fundraisings for this. So investors will need to be prepared if the REITs were to continue to grow and want to bring down the Festival Walk weightage, then this is something will need to be happen. So let's look at the Festival Walk, okay, which is a major contributor. The current occupancy rate is 99.9%. It's almost full occupancy. But however, one thing to take note is the rental reversion is minus 30%. There is a big drop in rental reversion on that. Okay. However, maybe you can say that this may be the worst is over for the REITs. After a negative 30% reversion, how much lower can they go to? As the market has started to open and the pandemic may be under control already. So this is another aspect. And also the insurance claim during a Hong Kong protest. However, this insurance claim is still not paid out yet. It's still on the finalization state and thus it still remain in progress. So this is something you need to think of, the insurance paid out for the business interruption on Festival Walk back in 2019, it is still not settled. It will take a while for it to settle. We'll see what will the REITs manager update us going forward in future. So let's look at Festival Walk. Festival Walk is a shopping mall that is not really affected by the closing of border by Hong Kong. Because Festival Walk, 90% of the contribution is from the local. Only 10% is from tourists or foreigner. Because it's more like in Singapore context, it can consider a suburban mall. However, the footfall have not really fully recovered. It is still only up to 83% of 2019 level. So indirectly, there's still more room for it to continue to move up to improve further. And let's look at the other properties in China, Japan, and Korea. We can see another very negative rental reversion is the property in Beijing. The office building, it also suffered a negative 24% rental reversion. Although it have a very high occupancy rate of 95.4%, the occupancy rate have increased, but the rental reversion have dropped a lot. Nevertheless, compared to the peer in other property in China, they are still better off. And we can see there's a very big jump in rental reversion of this Pinnacle Gangnam they purchased recently in Seoul. We have 58%, but do think of this is talking about, I think it's one tenant that do a reversion. So the data may not be that true on that. So it look big, but do think of the impact may not be very significant because it's mainly on one office list of rental reversions. However, you can see in general the occupancy rate for the property in beside Festival Walk all are still on a very high weightage. So let's look at the price chart. It still hover around the $1 price range. However, the dividend yield is the highest among the other three Mapletree REITs. One of the key reasons is because of their property are all purely 100% in overseas, and the risk expectation is higher, and thus investor will definitely demand a higher yield compared to the rest. One very positive about this REIT is the alignment of interest of the fund manager with the unitholder, where this is one of the unique REITs that their fee structure is not tied towards the AUM. Okay, a lot of REITs, how you pay the manager is based on a percentage of the properties. So if they continue to buy properties, the fees you pay to the manager will be higher. But whether does the property is yield accretive, DP accretive, that's a secondary issues. But for these REITs, they are not tied to property, they are just tied to distribution income. What does that mean? It means that the more dividend you collected, then the manager will have a higher income. So it will become a win-win for both investor and the REITs manager. So that's all I have to share with you today on the 4 Mapletree REITs result. In general, I'm still very positive on the 4 Mapletree REITs as they have proven to have a very good track record. Plus, when it comes to REIT selection, I always focus a lot on the sponsor aspect. Okay, because the sponsor is one of the key parameters they're able to help the REITs to grow over time. And their past track record of 3 of the REITs that have more than 10 years has show you that they actually have delivered very well. However, do remember that when it comes to investment, past performance doesn't guarantee future returns. But however, if the REITs, their past performance have been good, most likely their future performance will have a higher probability of better than REITs their past performance is not so good. That's all I have to share with you today. And if you feel that you have benefit from this video, do remember to like and share this video. And also do remember to leave your comment below to let me know what you think. Also, please remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.